Hi, I'm Luke Hanson McDonald, and this is my podcast about family business. So today's guest is a titan in the world of real estate investing and podcasting. Daniel Foch is the co-host of the #1 real estate podcast in Canada, the Canadian Real Estate Investor Podcast. He's also a co-founder and chief real estate officer of Valerie Real Estate, the first artificial intelligence-powered real estate brokerage in Canada. Daniel actually grew up in a family business, working alongside his mother and father, who were also both real estate brokers. So in this episode, Daniel discusses his view of where there are opportunities and potentially huge pitfalls in the real estate market today. He also shares his view on how the government can incentivize home building in Canada. And lastly, we discuss whether or not affordable housing can also provide a good return to investors. This is Beyond the Family Business Podcast. Let's jump into it. Who are you? Where are you from? And what do you do?
My name is Daniel Foch. I'm from the Greater Toronto area, and I'm a real estate broker, technically. Partners in a real estate brokerage called Valerie.ca, which is AI-powered real estate brokerage, and host of Canada's #1 real estate podcast as well.
Yeah. Which is called?
The Canadian Real Estate Investor.
Yeah, I'm a huge fan.
Thanks.
That's awesome.
I appreciate it.
And I've spoken to Nick before, and he was actually, when I was starting this podcast, gave me some really great advice. So, it's awesome to have you on the show. I really appreciate it.
My pleasure.
So your podcast, one of the things I love about it, it's very informative. You know, I find I can throw it on when I'm headed to work, and it sort of catches me up on what's the latest and greatest, that's going on in the Canadian real estate market. So I'm going to focus a lot, to start off on sort of getting your view of the market today.
Sure.
So my first question is really, what types of real estate are you finding attractive in this market, and why?
Yeah, it's a good question. I would say I'm not really finding any types of real estate in this market super
attractive. I was wondering if you were going to say that.
Yeah, I wish, I've just been searching near and far for a deal. I would say that there's certain things that are maybe oversold. I think, your Toronto condos are probably what's going to find the bottom the fastest, to be honest. They're just hurtling towards it. So I would say, for people who are into condos, and I represent a lot of larger institutional clients who are doing distressed condo funds, and they're already buying in the $700-800 a square foot range. Mm-hmm. So that is probably the one that stands out to me as will present the biggest broad opportunities soonest. I would say that add value, anything add value. I guess the one asset class or type that I'm bullish on is sort of your infill, multiplex sites.
Yeah.
Which is, there's people talk a lot about the missing middle. I think that the capital markets have a missing middle as well, where there's deals that are just too big for the small guys and too small for the big guys.
Yep.
And it seems like the people who are doing well in that space are really carving out a good niche, and they're very lucrative deals. So that would probably be the only other, and it kind of goes against the condo thesis in such that, you can buy a piece of land, construct a fourplex in the city of Toronto, and even sell it the same way you would sell a condo. Mm-hmm. And you could deliver that unit to market with total creation costs of $600-700 a square foot. Mm-hmm. Whereas, your high, or even less than that, honestly. Whereas your high rise, concrete stuff is, $800-900-1,200 a foot.
Crazy.
Yeah, so that's compelling.
Yeah.
And assuming that from a policy environment perspective, population continues to grow, maybe not in the next 2 years. I think it's pretty uncertain with the changes to the non-permanent residents. But if population continues to grow and housing starts are kind of falling the way that they are, at least in the city of Toronto, would be reasonable to assume that demand will need to be filled by somebody. And I think if it's filled by those investors, they'll do well. Yeah.
Mm-hmm. Okay, there's a whole bunch there to unpack, and I'm going to get to a bunch of those different points. So maybe starting off with the distressed condo fund.
Yeah.
Could you just explain a little bit more at a high level, what is the thesis of sort of the average distressed condo fund right now? Is it buy and hold, buy and rent? What's the thought process?
Well, they're not really clipping coupons because they don't cash flow. So, I mean, that's, I guess you would maybe even maybe break even on the cash flow. So the idea would be, if you're buying in a building at $700, I mean, 700 is low, but like high 700s a foot or even low 8s at a foot. And it's a brand new building. You're buying that inventory off of a developer kind of privately because they need to move it to whatever, get out of their construction loan. You're functionally getting an asset at like a 20% discount, right? Because everybody else, maybe even more, but you could, right now, brand new condos are selling at like 1050, maybe less, like maybe 950 a foot, even if it was 800 a foot. And if you're getting it at 7, like as long as there's a spread, you're closing with equity in the deal. So that's piece number one is, the fund investors like say the safety of those funds, right? Number two is it's a yielding asset, so you get rent, so it should service the debt and the condo fees. And then number three is in the fullness of time, it should appreciate in value. Will it go back up to $1,200 a foot or $1,500 a foot, like the pre-con values that they were selling at? Probably not. I don't think that that's what the investors are intending. I think their intention is that it'll go from, maybe we'll settle at 1,000 a foot, right? Based on inflation. And so if you hold it for 5 years, you still get all of that appreciation plus the principal pay down in the meantime. And you already bought at a discount, right? So if it goes from 8 to historical appreciation is like 4.11%. So, you just apply that CAGR and it goes to 1,000 in a couple of years once you find the bottom, right? The key is trying to find that bottom on the way down.
Trying to time the bottom. Yeah, that's always the difficult part.
Yeah. Well, they're kind of creating it, right? Like if you're the market maker, you kind of create the bottom, right? If you're buying hundreds of millions worth of condos, then
And with all those condos being, presumably if they're buying them and holding them 5 years, they're renting them in the meantime. So that is turning them effectively into rental units for a time period, which maybe was what a lot of the investors were doing anyway. But how is that affecting the rental market, or is that not a big enough drop in the bucket? Yeah,
like, I don't know, if you think of like, even like 100 million worth of condos is really only 100 condos, right?
Yeah.
So it's like, or even if they're 500K, it's, it's 200. Like it's not, there's 40,000 units coming online this year. So it's not like, it's a drop in the bucket.
Yeah. Okay, fair. And so then onto the multifamily. So what you're talking about of what's attractive, is that new development or existing stock that you find most attractive?
Yeah, so it would be basically if you're going to buy like so in the city of Toronto, and most jurisdictions across Canada are like this, or at least going this direction. We're seeing an upzoning of single family housing, right? So you can go buy, in the province of Ontario, you can now put 3 units on any lot in the province. So you go buy a house, you tear it down, or you add 2 other units. So you take a McMansion as an example, and maybe it's got a basement, walkout basement, 1,000 square foot main floor, 1,000 square foot upper level. You cut that into 3 units and you rent them out, and they yield, because there's not a lot of people who can afford to buy that as the McMansion that it was, right? It's a super limited buyer pool. So you benefit from the lack of competition kind of in that upper middle class residential home, let's call it. And then you benefit from putting that market into the rental pool for kind of that, not lower middle class renter, but the renter who can't yet afford a home, but wants, maybe a detached environment. Maybe they have a car. They don't want to worry about parking downtown, driving downtown, whatever. There's so many single family neighborhoods in the city of Toronto. That's just an example where, you're cutting it up. That's cheap to do on a per square foot basis. But a lot of guys were just seeing they're buying like, an old wartime bungalow or an old tear down house, and they're just raising it and, building from scratch.
Yeah. No, same thing happened in Halifax recently, where they basically put out a new center plan and upzoned tons of different areas, which, upset a bunch of people and blah, blah, blah. But yeah, no, I'm seeing that in other areas too. What are you staying away from,
Yeah, it's a good question. I mean, anything speculative we're staying far away from. And so it's hard to like really pull out what is and isn't speculative. Like an easy way to give you an example on this is like 2 years ago, we were really talking a lot about the CMHC MLI select deals.
Yeah.
And now that's really become a speculative play, right? Where you're seeing builders basically building pre-construction, sixplexes in mostly Alberta, where you can get hit the MLI rules pretty easily on the income side. And you're getting Toronto pre-con investors piling into that trade on the basis that, in a year when they close, that deal will cash flow. I don't think, based on the way that rents are trending, that many of those deals will cash flow, both rents and vacancies, right? So what CMHC has already done to kind of fix this risk is they've made it so that a lot of these deals are starting to have to be right-sized from a loan perspective, where it's called a rental achievement holdback.
Yeah, exactly. And it's basically almost like a conventional loan where it's 25% down through construction.
Yeah, and then when you go to occupy, they'll only give you the full loan if you actually hit the rents that you pro forma at the beginning.
Yeah.
So I'm not staying completely away from those deals, but and like this, when I say me, I'm more saying from an advisory perspective, because I've never really like bought a CMHC deal to stay in. I just think that they're purely an amortization play. That's not why I buy real estate. It's like really a debt play, right? I don't know. I can't really be convinced otherwise. Like, like what's the point in having your principal barely paid down? You're basically getting an IO loan to yeah. So I guess we're not super optimistic on those. Like I was 2 years ago when rents were growing, when values were growing, and especially in the Alberta market. Whenever CMHC first came out, I think that program maybe 3 years ago, very early.
Yeah. Started COVID or midway through COVID.
Yeah, I saw a lot of people do really well in that program. Yeah. It's now become a crowded trade, and I think so that's kind of one of the ones that we're a little bit more careful on than we were before. Everything else, like I think, I don't talk enough about like industrial and retail, but I have a lot of clients in that space.
Oh, really? Okay.
Yeah, and I mean, I think industrial is probably the one. We're seeing a lot of guys who are like really bullish on industrial, but it is feeling like with the trade war and stuff like that, maybe potentially overbuilt potential a little bit. Retail has been really the fascinating one, where nobody was really getting into it. It was very much a covered land play, so like values got accelerated from developers buying it, not for yield, and now you're starting to see a lot of those like original retail players get back in and being able to get deals on a yield basis rather than buying it as like covered land with development value. So those are all really dynamic right now.
Yeah, absolutely. Yeah, no, we have a background in industrial and not a crazy portfolio, but a decent sized one out east. And there was a record amount, like the valuation just went up so crazy during COVID.
Yeah, rents too. Rents doubled in the last 4 years.
Yeah, they went nuts. And so, you went from whatever $7-8 net to, $15, $20 net, depending on what region you're in. And, but it's so fast to build. And this was something an advisor had told me, and we've, as a result, not really got more into it. And I mean, out east, we saw I think it was 10% increase of new product come on the market, basically in a couple of years. And so when it's that reactive, it's always concerning, how quickly will that get absorbed by the market. But on the flip side, and I'm not giving any kind of advice here, just some of the stuff I've heard, one of the interesting arguments I heard was with the trade war, it may require a lot more localized logistics. Even though there'll be a reduction in trade across the border, it would mean more local DCs, so maybe that offsets it. Who knows? Interesting. And how about as far as existing stock of apartment buildings? Is that something that you deal in much?
Yeah, we have some clients in that space. I mean, the yields have just been pushed down so low by mostly the CMHC program, to be honest, that it's not like, look, if I have a client who's multi-millionaire and they have their own investment thesis, it's not typically my place to advise them on their to help them create their thesis, right? So we're brokering stuff like that where people have said, this is my parameters, and they're looking to, they come to me saying I'm looking to buy somewhere in the low 4s on a cap rate basis, right? Or high 3s even. I mean, So, and you're starting to see, I think, a little bit of expansion in that space, but not a ton. Like, a lot of the expansion came from it kind of just like chasing the interest rate or the yield curve up and down.
Yeah.
Right. Because it kind of stays within like, I don't know, a couple 100 basis points of the 5 year, I guess. So yeah, I mean, like we're seeing activity there, but I think a lot of the folks who are in that space who get, asset management for multifamily, they're looking at what's happening with the upzoning and saying, why don't I just build it, right? Like your yield to cost is the same as your cap rate. So why not get a brand new asset that you can depreciate and you're not subject to rent control, right? If you do it right, you can get some advantages on development charges, et cetera. Rents are higher. I don't know, like, so yeah, we're seeing some, but it's a kind of more specific group of investors, I would say.
Sure. So I listened to your latest episode, which was sort of all about if, the construction industry in Canada is in peril, which was a great episode. What is your view on, what are the things that the new government, whoever it is, needs to focus on fixing in order for, the housing market specifically to go forward?
Yeah, it's a good question. I think we need to make it a lot easier for people to build. We have, I understand red tape or like rules, right? Like, a lot of people say, they'll name some country, they're so good at building because their buildings fall down all the time. It's like, well, ours aren't really that good either, right? Like, you go through a brand new build condo, I won't name any names, but like there's leaks, there's, curtain wall issues, there's elevators failing, et cetera. So like we don't really necessarily get the premium quality result that you should expect with all of the bureaucracy associated with creating housing. So if we're not going to get that, and I actually think people are probably more likely to build to a higher standard if you give them some autonomy over that process, right? So their engineers, their quantity surveyors, their trades, all of their specialists can and should be the ones really, really underwriting and owning that process rather than all of those people at the municipal government, right? Like we need to put more trust in our private sector planners, landscape architects, et cetera, not have three red lines and all of this stuff. The process needs to be shrunk a lot, or it needs to be made to be more simple, and the rules need to be easier to kind of like a easier box to follow, not because it's all just interpretation, right?
Yeah.
So that's probably number one. And I think, from a policy perspective, it seems like, you've got one housing policy that seems to be like remove barriers, and the other one seems to be like, well, we'll just build the houses because we understand the barriers. And both are like, I don't know, credible ways of dealing with that problem, right? I think the challenge with we'll build the houses is if you go look at Altus construction cost guide as an example, the difference for building a private sector square foot and a public sector square foot in the same asset class is substantially different. And the public sector isn't really good at allocating capital, so things get more expensive, and that would probably pull the whole market up. From a construction perspective, like in construction industry, I think either the whole policy future post Canadian election, et cetera, we're in a recession. We're probably going to see a lot of make work. The way that I think I would encourage people to think about this is like infrastructure is like an add value layer for your real estate asset. And so if Toronto had better subways, it could, be maybe a more comparable city to New York or Chicago. And, we might actually get some, better floor in values or, and so you kind of want the government to actually be, especially if like, we see 10% construction unemployment, which is honestly within the range of potential outcomes from my perspective.
Yeah, 100%.
They're going to be doing, you always saw make work projects, all the brutalist buildings in Canada, the Trans-Canada Highway, all the railways, they're all recessionary make work.
You guys brought up in that interview, or in that episode, the train that was mentioned at the end of sort of Trudeau's campaign or the end of Trudeau's tenure. But, that train from Toronto, and where did it end? In Quebec City?
Yeah.
That corridor, it'd be a giant employment thing, but it would also allow people to obviously live in different communities and work in the inner city, et cetera, right?
Especially with hybrid work, right? Like,
Yeah.
if it's like, if I could get a job at in policy in Ottawa and commute twice a week on a train, I would do it. But I'm not going to move there.
Yeah.
So
100%. So with that, obviously you were literally at Pierre's event today. You were mentioning to me, but what elements of either of the two, leaders or the two highly likely winners of this election, what policies do you think make the most sense, and which ones do you not like?
Yeah, sure. I don't like the government being a home builder.
Yeah.
Well, like, I would get it if we were like, even if we were comparable to the US, I would say, yeah, okay, maybe the government could step in and be a decent home builder and provide something better in the market. We literally have like a world-class housing construction market, right?
Yeah.
Like it's like the envy of many places that, and we have Canadian builders who are going and doing miraculous things in the US markets, right? Because they have this such a good skill set, because our construction and housing construction, specifically industry, has been so strong since the last cycle, that probably in the mid 90s, right? And so they've really refined that process and the brutal bureaucracy in front of them has forced them to get better at it, right? So I think it would be doing a huge disservice to the industry for the government to try and step in and compete in that space.
Fair.
I like Carney's MERB program proposal. We talk about the MERB program a lot on the show. It was canned because of like abuse. Like it was, it was basically about, it was too easy to be overexploited by wealthy people. So
what is the MERB program?
So the MERB program basically allowed you to like build a building like the one that I was saying before, and then use the depreciation tax credits against your personal income. So if you're like a doctor, you can own that building. Well, you could do that if you were taking the income, if it was in the same like, business stream, right? But but the MERB program would allow you to basically tax deduct real estate depreciation or building depreciation against your personal income. So if you're a doctor or a lawyer or some other high earner, which there's a lot of in Canada that are fed up with the tax system, it's a pretty good way for you to build assets and get a tax benefit. It's better than pumping all your money into an RSP at the end of the year or whatever other system you're using to try and avoid taxes, right? So there's that which I liked. And I think I do think there's a bit of an issue because it doesn't address like the disparity that would create, but that doesn't bother me so much because I think most policies, that's a necessary evil, right? So those were good. I think the other pieces that Carney in their platform wants to spend a lot on infrastructure, and I do think like among people in the world, he's very uniquely qualified to be good at creating infrastructure, right? Like set aside like everything else, the guy ran Brookfield, and they are good at doing that. They're very skilled capital allocators in that regard. Does it leave the door open for conflict of interest and cronyism? Of course, obviously. It's funny that the right now has an issue with that when like 6 months ago when Trump was running, they were like, oh yeah, we're cool with a little bit of it. And now the left's like, it's funny, like in November, the left was like, oh yeah, can't elect Trump. He's like, there's conflict of interest and cronyism and whatever. And now they're like, we can tolerate a little bit of cronyism. So that's funny. On Pierre's side, I mean, his housing policy is pretty simple, right? Like it's reduce taxes, reduce red tape, and only give municipal governments funding if they reach their targets. It is. I don't think it's actually possible, to be honest. Like I think that it's very idealistic to imagine that you could. I just can't. I know municipal governments. I work with them all the time on this stuff, and you just can't force them to get their shit together. And they're not going to, and then they're going to be in a big financial issue, and it'd be like accidental austerity, which is just not what we need during a recession. So that's kind of my concern with his proposal. And I think the proposed like 1031 exchange thing was fascinating.
What's that?
So basically 1031 exchange in the US is like you can sell an asset, and as long as you roll it into a like asset, then you don't pay, the capital gains get rolled over. He was basically proposing the same thing. The language was kind of loose. But it was like you could sell an investment property and then as long as you reinvested it in Canada, it would be cool if it was like equities or something, because then you get all of those boomers who are sitting on like, you know, recreational properties or like, you know, the odd rental property or whatever. If they could take that equity out and put it into TD Bank or, you know, RBC. Yeah. It'd be a sweet program.
Yeah.
Yes, because I think that helps to improve the incentive to liquidate, which we need to create an incentive to liquidate for a lot of these people who hold so much of their wealth in like 60% of the real estate wealth in the country is held by people over 55, right? If we can give them a good reason to sell without taking too much away from them, right? Like now all of a sudden that tax savings or perceived tax savings almost gets capitalized into the sale, right? They're going to be a little bit more lenient on price. They're all probably, many of them far more likely to sell. A lot of those people don't want to hold a management intensive asset into retirement. Like, why would you want to do that, right? They do because to try and take that capital out and put it in anything else, you're now you just lost. You're reinvesting only 75% of your capital, and so that's I think that's a great proposal.
Yeah, no, that's a really good point. So, do you think that making affordable housing is possible? You bring up the private versus public, you know, building of housing. Do you think making affordable housing is achievable while also making it a good investment?
Yes, I do. It would require land costs to come down substantially. But yes, for sure. Like we invest in affordable housing in markets that are where land costs are low and where you can buy a duplex at, you know, like every single one of our buildings was insured over what we paid for it because the replacement cost was so high, right? Compared, because you know, so there's certain markets where assets are so depreciated, and as long as you're providing those rentals, like you can do it now, and that's not building. From a building perspective, you could do it if your land costs come down substantially, which is already happening and is going to continue to happen. So, I think we can and will build a lot of affordable housing that investors will be happy with over the next 10 years, to be honest.
And what about, do you think that any of this modular or prefabbed, you know, building materials, prefabbed houses, do you think that plays part of that?
Not really, no, to be honest. Like, I mean, it's not real. It doesn't erode your construction costs enough. Like, the last build that we did, we quoted it at regular framed, even the garden suites. Like, you know, one of my partners is doing them all the time. We've quoted them in a factory versus on site, and he's doing them cheaper on site. So, you know, unless somebody knows some magic formula that I don't know to get these built cheaper in a modular way, I don't really see it happening. It's quicker, maybe a little bit, but like, it's residential rental. It's not, speed to market isn't a huge factor, right? It's not like you're building like a distribution warehouse for Loblaws or something.
Yeah. Okay, interesting. And do you think, the last question on real estate, do you think that you brought up the MLI Select and how the program's changing. Do you think that is counterintuitive to, you know, trying to encourage more housing being built, or do you think it's necessary given the increase of risk within that sort of asset class?
Yeah, I think it's necessary because if you give Canadians a really stupid credit product or even a really good credit product that like has a small margin for stupidity, they're going to find the stupidity and exploit it and create risk. Like we saw it with condos, we saw it with single family detached, we saw it with, you know, first time home buyer incentives, with, you know, 95 LTV mortgages, with HELOCs, with everything, right? Like we are obsessed with debt and debting ahead, right? Like using it to kind of compete with one another. And until we see a deleveraging, like the regulators need to be putting guardrails up for people. I mean, you know, you asked about, can we create affordable housing? And right now, the only affordable housing that's getting created is through that program. And the only reason it's being done is because there's a greater fool, the investor, who's willing to take that loan and spread it out over 50 years rather than 25, because they think that there's an appreciation play or a rental increase play on that asset. And the same thing was true for condos for the past 10 years. People were buying condos and renting them out cash flow negative. Maybe not for the past 10 years because there was a low interest rate environment, but like for the past 4 years.
Yep.
And they're basically subsidizing the rent of like the finance bro who's living in the in the unit, right?
Yeah.
Because they felt that the asset's going to go up in value.
Yeah.
That, and ultimately the cost of that rests on society because we absorb it through inflation. Like that's inflation.
Yeah. And
inflation is just like a tax that you don't pay.
Yeah.
Right?
Yeah. No, that's a good point.
Yeah.
That's an interesting perspective.
Yeah.
Subsidizing condo bros.
Yeah, well, I mean, it's funny. Like I always just use the condo bros because like all my buddies are the ones like renting these, and those are the only people that I know. But I imagine there's all people from all walks of life.
Yeah,
but like
yeah,
I just those are the ones I'm most comfortable making fun of.
Yeah, fair enough. Okay, moving on to family business. So you're from a family business. Can you give a quick sort of history?
Yeah, sure. I mean, my parents have been in the real estate brokerage and I guess like ownership and development space for my entire life. I think my mom actually got her license when she was on mat leave with me, or when I think that was when. I worked with my parents for 7 years, I think, doing like the brokerage side. My dad did kind of like land development, etc. My mom did residential. I kind of like picked up the slack between them, and then sort of just like I think you're probably familiar with this. Like I think there's kind of like differences in where we wanted to take things, and so I kind of just went out on my own. Went to a brokerage called Rare, where they were like a big advisory shop and pre-construction sales company for large developers in Toronto. Was there for 2 years doing like a bunch of economic research, advisory, etc. And then just joined this startup called Valerie.ca recently. I guess not that recently, but like 6-7 months ago. In hopes of kind of like disrupting the real estate, I guess web platform space, but also the brokerage space by offering kind of a bit of an AI spin to both end users and realtors. So
cool.
Yeah, but the family business was good. I mean, I learned. It gives you an opportunity. I guess it could be potentially nepotism. I don't know if that really exists in like the
nepotism exists.
Yeah,
for sure.
Well, I mean, but in like the in the entrepreneurial space, I guess it put me in front of clients that I would never have been able to go get on my own.
Sure.
And so that allowed me to learn a lot quickly. Right, it'd be like kind of the benefit of being at a small company out of university as well. Right.
Yeah.
Got like a lot of. Really just trial by fire. I was seeing things that like and being immersed in an environment at a much higher level than I would have had I just gone and started on my own or worked at a different company.
Yeah, for sure. And so there was obviously a lot of benefit. You learned from your parents, et cetera. First of all, is there any one lesson that, your parents bestowed upon you that you think has, served you well over time?
Yeah, I think like there was a lot, to be honest. It was the hard part was to try and figure out one, but I think the big one was really just like lead with value. It's almost like, I don't know which like economist really, it's like either like Austrian economics, but like Marx kind of almost described this the best, which I'm always reluctant to quote Marx for obvious reasons, but like the way he describes like surplus value of like, if you can sell someone's labor for more money, then you can pay them for it. But there's surplus value as like being a customer service rep as well. So like if you can give someone more value than they're paying you, you'll have a customer for life, right? Because they're always going to come back because they're always going to come back to capture that surplus value. And so it was always just that. It was like lead with value, do whatever you can to really like level up the experience for customers. And that's like really driven everything that I've done with the podcast, with Realist, which is our education spinoff of the podcast, with the brokerage, I'd say that's probably the biggest one.
Awesome. You went on your own path.
Yeah.
What have you done that's, different than how your parents, ran their business? What is the, unique skill or experience you've had outside of the family business? I
think that, a lot of it is as simple as just like technological refinement of things. Like I think that or like a boiling down, like you put something in a pan and you really like, reduce it to its essential parts, right?
Mm-hmm.
And I think that's really what I've done is I don't have like exceptionally good attention to detail. I'm not, I bounce around a lot. I have a hard time focusing. And so that environment was difficult for me. Like the environment, that the way that they did business in much more of like a classic way was very difficult for me to like adhere to their standard.
Mm-hmm.
And I think it created frustration for both parties, like for them and for me.
Mm-hmm.
And I just realized that it probably wasn't something that I was ever going to get to. And I don't think they were ever going to dumb their business down to my level. And so I think what I've done is I've kind of created something that works for me and boiled the real estate transaction really down to its essential parts and tried to do a really good job at just those things. So for me, like the first layer of that is analysis, right? I'm very good at analysis. Like that's one thing I don't even, not afraid of bragging about, right? Like,
it's sort of what you're known for, is being a data junkie, right?
Yeah, exactly. And so, that was what I often led with when I would, even with their business, because if they would put me in front of a customer, maybe they were traveling or something, and the client was like, "You're young, like, how do you know what you're talking about?" And I'm like, "Well, let me show you these charts," like, and that's how I'd add credit. So I think like a lot of it was just that. It was like, I would take, they were typically like realtor stuff. It's like you're sending out a market report on a monthly basis. It's like, well, let me just make this like a wicked thing. And I used to have like these Excel macros that I would just like, pump Treb data into, and it would create this beautiful infographic instantly. And that's like a very simple example of like, okay, there's step one, like your monthly market report. Let's just turn that into like a simple thing. And they're like looking at this, like, what, it's like,
how do that?
And for me, it was like, well, I don't know. I learned this like in first year university. So just little, like, I would call that an incremental thing, but I think like for them to look at it, it's like a world of difference, right?
100%.
Yeah.
I really like also, you're really saying that you figured out how to lean into your own strengths and stop trying to be your parents. The way they did things worked for them, but it didn't work for you. So
well, and I think it worked really well for them. But it works less and less well for the modern world too, right? Like over time, I think there's a diminishing return on the way that they do business as consumers' expectations change. They want a lot of things done more digitally. COVID really kind of hit that hard, right?
Yeah, big time. So one of the last questions here. So you have a AI-based real estate agency. I assume that's if you're a data junkie, that's almost the ultimate pivot of taking that skill set and you have all that data and now, using AI to get even more value out of it. Can you explain what does that business do and how is AI integrated? Yeah.
So basically what we do is we use AI to really bridge the gap between the end user and the real estate professional. And maybe the whole like destination at the end of that bridge is all of the data that like the real estate board uses. Right now, the bridge is the realtor, right? And so there's certain things that that AI can do better than an agent, like provide answers to answers to quantitative questions, right? An AI can find an answer or create a chart quicker than I can now, right? And probably a better looking chart if you really prompt it properly. So there's that. We don't even use charts. Like we use like things like matrices or stuff like that, right? Where it's like, I want to compare these two properties side by side. Like that's how I shop now. I shop on ChatGPT. It's like, show me the two, robot vacuums, like the top two robot vacuums side by side, right?
Especially with deep research.
Yeah.
It's unbelievable.
Yeah. And you just get it in a table and it's like, okay, boom. Like that's how I don't know. It's like, that's what you would do, I think, at Best Buy anyway, like compare them side by side, check the features. Like it's gone from an hour to a minute. So that, like for houses as an example of something that we can do. So that's like consumer side. I think we've really refined the search process. Platforms like, Realtor.ca, Zillow in Canada, I guess you have like House Sigma, Zolo. They've really made it so that like consumers can get further and further in the process before they engage an agent. And we want to push that limit even further, right? Where they can start, asking questions, determining their affordability, underwriting their own mortgage, shopping by mortgage payment, starting to do some of those calculations, land transfer tax, taxes, whatever, right? Where, and what that allows us to do as a real estate brokerage is when that person says, okay, I'm ready to go see this house with a realtor, they're a much more qualified buyer than they were, you know, further behind in the process. And so that allows us to give really good leads to our agents. But it also allows us to give a really good customer experience to that person who wanted to kind of DIY it as long as they could. And it allows us to get to know them better so we can pair them with a really good agent.
That's a super interesting and concise way to explain it. And you're absolutely right about the quality of the leads. I hadn't really thought about that it's allowing a person to almost become better educated prior to speaking to you. And then that way you probably get less, you know, people that don't even know what they're looking for, so to speak.
Yeah.
Yeah. Oh, that's really interesting. All right. We're almost out of time here. The last question is just, where can people learn more about you and everything you're doing?
Yeah, if you just Google me, typically like Google will put whatever platform you're most likely to want to find me on in front of you. So Daniel Foch, Foch. I'm on like pretty much everything: TikTok, Instagram, Twitter, X, YouTube, although not super reliable on there. All the stuff, you know, LinkedIn, whatever. Yeah. And just like send me a DM or an email or whatever. I love to just meet people and chat and especially talk about and learn about real estate.
Cool. Thank you so much for your time.
Thank you.
Really appreciate it. Thanks so much for watching. This is Beyond the Family Business Podcast. Please like and subscribe. All right, take care.